Good day, everybody. Let's get started. So welcome everybody to this month's webinar, all about aggregator CEOs discussing the future of the e-commerce aggregation space. So let's kick off. The agenda for today's webinar is fourfold. It's quite a long webinar. It's a 2-hour session because we have so many great speakers and a lot of key content to discuss. We'll kick off just 2 or 3 minutes giving a brief update about the ForTier Group and our deal flow. We'll then provide an update about our webinar series. We'll look at today's webinar, but also we'll help you decide what topics we should speak about in future webinars via our live poll that we'll do. Then we'll jump into the meat of today's webinar, where we have 10 CEOs challenged to give TED-type talks to the audience. They have 5 minutes each to give really inspirational talks about the future of the e-commerce aggregation space. And then we'll have hopefully at least 50 minutes for a discussion on some of the key topics that will fall out of section 3. No doubt valuation will be one, very topical given the looming recession we're entering. And we'll have lots of time to discuss all the other key topics that you, the audience, want to table. So let's jump in. So a brief update from the ForTier Group. Just for those that don't know us here at the ForTier Group, our exclusive focus is M&A for e-commerce companies. That's all we do. We don't today focus on equity or credit or any other type of product. We simply sell e-commerce businesses. That's what we think about every day. There's 3 specific solutions that we provide to e-commerce entrepreneurs. The first is a valuation estimate, which is key at the moment, clearly because there's been a reset. We're very happy to provide a free valuation estimate for any of the sellers on the call today or that are watching the recording. Please reach out to the team for that. We're, I think, one of the few, if only, firms that has a dedicated exit ready program. So for clients that are not ready to sell today, that may want to sell next year or even the year after, we invite them to become part of our exit ready program, which improves their business and gets them as ready as possible for the ultimate exit process. And of course, all roads lead to the exit process. I'm ex-Morgan Stanley and Credit Suisse, and we've adopted a comprehensive 7-step investment banking type exit process for all our clients to go through. In our view, we often get asked the question, how do I get the best payday? How do I get the best deal? In our view, it comes down to the 3 Ps. So sellers need the right people on their team. They need to adopt the right process and approach all the relevant purchasers. From a people perspective, it's surprising that some entrepreneurs do it alone, even though it's their first rodeo. Even Fortune 500 companies seek advisors to advise them on their exits. Therefore, we think it's fair that e-commerce entrepreneurs should do the same. I have 20 plus years of corporate finance, stock investment banking experience, and I have a great team around me. So we have a great set of people that can advise you and be on your side of the negotiation table. The second is process. Real great sports leaders always talk about the process of their team in preparation and so on, and that leads to the right outcome. They don't focus on the outcome or the score, they focus on the process. And we're the same here. We focus on the detail of the 7 steps in our process, and that, if followed correctly, will ultimately lead to the best outcome. And third is purchasers. So it's important to approach all of the relevant purchasers, whereby that may be all the aggregators. There are 130 aggregators in our CRM today. Some FBA focused, some DTC focused, but also if your brand is big enough, your business is big enough, private equity firms, typically you need to have at least $10 million revenue, but that opens up a big new list of buyers. And then corporates or strategics that might want to acquire your firm. It could be a competitor. So it's important to approach all of the relevant purchasers in order to get a really competitive auction. Today, the ForTier Group has 17 mandates. 9 are live in the market, and 8 are in our exit ready program, leading to exits later this year or next year. So we have a lot of live relevant experience. Despite market conditions, deals are getting done. It's a really important message to convey. It's not true that all aggregators are paused for business, and hopefully the CEOs will communicate that. Yes, some of the top, maybe 10, some 3 to 5 of the biggest aggregators have paused acquisitions for the next few months. But the majority of the small and medium-sized aggregators have to do deals. They've raised money to do deals, and they'll continue to do so. Valuations clearly will be a little bit lower than before, but deals are getting done, and we're delighted to have 9 in the market at the moment. Last thing I'll say here is please do join our referral program. It's a big part of how we source business, particularly from entrepreneurs we've worked from, and indeed from aggregators. Please reach out to me direct if you'd like to join the referral program. So that's enough about the ForTier Group. Now we want to just talk about our webinar series. We've been doing a monthly webinar since October last year. It's part of what we call our learning hub, which is designed to help e-commerce entrepreneurs ultimately get ready for an exit and get the best exit possible. Today's webinar and all the previous webinars are available via our website. All recordings are all available. And there's other resources such as our 95-page exit guide designed to help Amazon FBA entrepreneurs think about their exits. Back in April of this year, we asked you, the sellers, the audience, what you wanted us to cover in terms of topics. And the number one choice was aggregator CEOs discussing the future of the space. So we're delighted that today we've turned that preference, that request, into a reality. We've got 10 great aggregator CEOs talking today. We have the founder of the first aggregator. We have 6 FBA aggregators, and to balance that out, we have 3 DTC aggregators. So delighted to put on this big showcase today. Before we jump into the meat of today's webinar, we'd like to do a poll of the audience to determine what topics we should cover in the webinars for July, August, September. So we'll start a poll in a moment. The options that we're giving you are, number 1, I'll start on the top left. What are the acquisition criteria of buyers in a bear market as opposed to a bull market? So what's changed? How to become exit ready, how to get as prepared as possible. A survey of M&A professionals at aggregators. We did that last October, and it may be time to do it again. Top right, revenue-based financing to grow brands pre-exit. Clearly, a lot of e-commerce companies are using revenue-based financing as a way to take it to the next level before an exit. Interviews with sellers who exited. And then a deep dive on valuations. We'll certainly touch on valuations today, but maybe we need to do a deep dive on that topic. And other topics. If you press other topics, we'll follow up with you after words to find out what other topics you want to discuss. Okay, so let me launch the poll. Okay. You should all hopefully see the poll there. Please insert your answers, and we'll just give it a minute for people to submit their thoughts. Thank you. Okay, we'll just give it 10 more seconds. There's 140 responses so far and climbing, so we'll just leave that go for a moment. You can probably guess. What's the most topical. Okay, let's call it there. We have 144 responses from an audience of 218. So I will share the results. Can you see those now? So number 1 is acquisition criteria of buyers in a bear market. Clearly, the criteria has changed or been amended in the last few months. There's probably more focus on net margins, etc. So that would definitely be an exciting webinar to put on. Deep dive and valuations. Yeah, agree with that. There's definitely been a reset. We'll discuss it a little bit during the panel today. And we actually did a survey of 35 aggregators in the last few days to get their up-to-date thoughts and valuations to help the conversation later on. Excellent, thank you for that. So I will now stop talking and, oh, sorry, the final thing is we have great content sponsors for all our webinars. Some of the leading aggregators have partnered with us on a commercial basis to partake in our monthly webinars. Today is clearly a bigger version than normal. We are looking for title sponsors outside of aggregators, most likely, whether it's a revenue-based financing company or others in the space. We're looking for title sponsors of our monthly webinar series. If that's of interest, please reach out. Okay, let's jump into the meat of today's conversation. So delighted that we have 10 TED-type talk conversations from CEOs of aggregators. And first up, we have Richard Jalichandra, who I reached out to maybe 2 or 3 years ago now, and Richard has been on the advisory panel of the ForTier Group since then. Delighted to work with you, Richard, and look forward to your talk. Over to you.
Good morning, good afternoon, good evening, wherever you are on this planet. My name is Richard Jalichandra. If you want to go to the first slide, my name is Richard Jalichandra. I was the founder of 101 Commerce, which is looked at as the first institutionally backed aggregator in the Amazon FBA space. After exiting that, subsequently, I've been doing a lot of consulting, almost 100 consulting engagements with private equity investors, debt funds, aggregators themselves, including some of the people I see in this Zoom. But I am going to kick this off by actually going back. Most of the other guys are going to talk to you about things that are happening now and where they see it going. But I want to tell you the origin story of how 101 came and was followed by almost 150 others. If you go to the next slide, I want to go back even further than the founding of 101 Commerce and just talk about Amazon FBA for a second. Amazon FBA was started in 2006, but it wasn't really until about 2014 that something happened inside of Amazon where Amazon, I think, realized with the success of AWS that FBA could literally be FBA AWS for retail. So something exploded there, and all of a sudden, all kinds of entrepreneurs and solopreneurs started running into the space. We flip forward to the next slide, which is in 2016. I was hired by a big private equity fund to come in and save a $500 million a year e-commerce direct-to-consumer site, selling vitamins and supplements. Within a couple months of taking that job, I called the investors who had hired me to save this company that was literally almost doing $500 million a year. I said, your company is dead man walking. And they're like, what do you mean? I said, well, it's going to be death by 1,000 paper cuts. And they said, what do you mean by that? And they said, is it Amazon? And I'm like, yeah, it's Amazon, but it's not what you think it is. So the immediate assumption was that our wholesale business was our current partners, the vitamin supplement manufacturers, were moving to Amazon. And that was certainly some of the fracture in the business. But when I dug a little bit deeper, it was literally death by 1,000 paper cuts. It was 1,000 mom and pop vitamin and supplement sellers that I'd never heard of. Mom and pops that had started their own brands, done their own manufacturing relationships, got their trademark and started selling an Amazon FBA. And essentially that $500 million a year e-commerce business is now probably less than a fifth of what it was. And it was largely through a bunch of FBA sellers doing that. So obviously that didn't go well, me saving that company, and we decided to part ways. And in 2017, when I was playing golf in semi-retirement, I couldn't stop thinking about all those mom and pop sellers. So I started reaching out to look for them, and I found a bunch of solopreneur and e-commerce communities and digital nomad communities where the number one topic was everybody was starting an FBA brand. And I kept hearing the same story over and over and over that, I'd meet I literally met, I think, 400 sellers who were doing over $1 million a year that had over a 25% net margin. And so if you flip ahead, I'm kind of already into the solopreneur story here, but I kept hearing this story over and over and over. And I kept asking, wait, I was thinking, doing the math, and like, normal direct consumer sites at scale, the most profitable ones were running at 16 to 18% EBITDA margins. And I was like scratching my head thinking, if you could just, aggregate a bunch of these that were doing 30% net margins, you would have by far the most profitable e-commerce company ever made. And if that's where you flip ahead, to the next slide, I went around and I started asking all these solopreneurs I've met, how come nobody's rolling these things up? And the answer I got was, oh my God, I know there's a group over here that's raised so much money and they're buying up brands. And I'm like, well, how much money have they raised? And they said, they raised $3 million. And I was kind of scratching my head because in a long-term technology career of being a 6-time CEO, I'd raised over $300 million of debt and equity. And I was like going, $3 million, that's not, much. If what if we talked to some real big institutions and said, what if we bought 100 of these things? And that was literally how the idea for one-on-one commerce was formed in 2017. And of course, we rounded it up to 101 for catchy branding. That's why it became one-on-one commerce. If you go ahead to the next slide, everybody wonders what happens to what happened to one-on-one commerce. Well, if you study almost any new industry or new segment, it's an old adage that the pioneer usually isn't the most successful in the space. And it's usually the fast followers who can go in your wake that end up being more successful. If you think about, like, in social networking, first it was Friendster, and then it was MySpace, and then Facebook figured out a way to crush it. We didn't have the success that we wanted. I think the investors didn't really understand what we were trying to accomplish. It was too early. We didn't have the right kind of funding structure as well. There was absolutely no availability for debt. So it ended up being a sideways exit. We merged it into a larger e-commerce company, which has subsequently become an aggregator. And that's kind of what happened to one-on-one commerce. I'll spend the last couple of seconds here just talking about the current thing. If you go to the last slide, you're going to hear a lot from the next 9 speakers about where this is all going. But the quick take is, recession's on everybody's mind. There's been a lot of investors and boards who have basically said, hey, either press the pause button or go slowly. We also think that there was so much money, $12 billion that was put into this space in 18 months. And I think a lot of aggregators, frankly, have gotten out over their skis. So they're trying to slow down, and some are actually probably in trouble. So I think you'll start seeing consolidation of aggregators buying and merging with other aggregators here, in addition to buying many great brands. And with that, I'll turn it over to some of the other aggregators to tell you what they're up to.
Richard, thank you for kicking off this whole industry and for kicking off today's webinar. Nick from Axel. Nick, are you there?
Yeah. Hi, everyone.
Welcome, and over to you, please.
Yeah, thanks for this opportunity to be with you today and share our views and our thoughts about the space. Can you please go to the next slide? Yeah. So definitely everyone's understand that there is like interest rates increase. There is like recession could happen. There is definitely inflation, but what we still believe, and this is like good news for the space, that we are in the business model where we're not like burning cash that much. That, for example, SaaS stories or fintech or any other great space to be, but they are like burning cash a lot. So we do see, like, for ourselves and for a lot of other aggregators, that we at that level where we not like burning cash, so we are quite like substantial with the interest payments is all our expenses, and still we're in the zone where we can like show like high ROIs. And this is like what we do believe is really great about this business model, about this space, and we do believe that it will attract more investors. Definitely, there will be less liquidity in the market, but we do believe that our business model and the space is well positioned in terms of like cash burn, which is like definitely right now much more expensive versus like the ROIs that we can show for the equity investors, especially taking account that we can leverage the debt to acquire brands and to like finance our NPD and our growth. So this next slide. Definitely, we all like have, I would say, like a lot of challenges and headwinds, but still we're talking to other teams, we're talking to big sellers, and we all see some opportunities and levers that can help us, to overcome, to like offset all the challenges and headwinds. And I would say like there's like three main like categories that we are like talking internally. This is the tech side, the operation side, and growth side. And definitely in tech side, we're seeing that there's also like great tools like Helium 10 or even like much more niche one that helping us to build and manage all the operations and all the growth. But still, we're seeing that there will be like less money for this like SaaS tools because they need to burn and to build that. But on our side, like internally, we see that there's a huge potential, and we definitely see that in our operations for data-driven like sales forecasting to freeze less money in working capital. Definitely some great models working for the price and promo. Like we are not in offline where you can change like prices every month or every quarter. Going online, we can change pricing like every hour, and especially with current like margins, like 20%, let's say this way, we definitely see a lot of different like optimizations, whether like what the optimum for the pricing, promo, and performance marketing spend, and definitely like machine learning models help here a lot. And there's like other stuff like on tech, like which can help us to like offset the challenges and headwinds. In terms of like operations and growth, definitely we see that the Chinese government pushing like yuan like depreciation, and it really helps for us to talk to our suppliers and to get better terms, not only for logistics but also for cost of goods sold, for purchasing prices. And really like we already see it on our P&L. Definitely like supply chain was a nightmare for the last like 2 years, but now we are seeing it's like stabilization, and we're seeing like at least like 50% reduction in the shipping costs from China to the US, which also helps to to have like better margins on our side. Yeah, and also like we see that Amazon really trying from one perspective. In some areas they are not that easy to deal with, but in some like streams, in some projects, they really helping, whether it's like small and light program or whether it's like they're batching like logistics. So we see that they're also like trying to help, especially big sellers, to perform better, to to drive growth and to bring like better products to the client. In terms of like the growth, we do see that there is this like kind of like a lot of like other marketplaces that we can go, whether it's Target or it's Walmart. Definitely the penetration isn't that big right now, but we all seeing that the growth are there. Especially with the increasing CPC on Amazon in D2C, we're seeing that there is like more and more opportunities for us, at least for this like 12, 18 months, to be in wholesale, to be in B2B, to be in with other retailers that are pushing online. And there's like the third slide, you can please, yeah. Yeah, so like where we believe that it's all what we are expecting to see in the next like 18 months. We definitely there's will be like consolidation. Definitely there will like some bankruptcies. Not like all aggregators will make it. What we also believe that there is like will be attempts to bring new revenue and contribution margin streams. Either it's like software for third-party sellers, or new product development, or any other like sub streams for the revenue. We also already seeing and also trying to internally understand whether this is the way for us, that some of the aggregators, they're trying to be more specific in terms of categories or regions or any other. like angle that will help them to be more efficient and to have like better pitch for the investors for their like next round, or just like to be internally better focusing on something where they believe they can be more expert and bring more value. So yeah, I'm like, I can only wish good luck for all of us, and yeah, like we definitely will manage all this very interesting time that is expecting for us.
Great. Thank you, Nick. I really like this slide in particular. It's a good summation of all the all the themes that we're seeing as well. So thank you for your discussion, your talk. So up next we have Santiago. Santiago, are you there, please?
I'm here.
Over to you.
Can you guys hear me? Cool.
Yeah.
So hey, I'm Santi. I'm the co-founder of Bade. We started in 2016 our first FBA brand. We're actually RJ's and Richard's fans from Austin. We met, I don't know if you remember us, but we're old-time FBAers. We actually started 5 brands since then. In 2021, we got really lucky with really great investors and we started acquiring. We've closed close to about 100 million in transactions since. And one thing about myself is that I fly tiny planes and like tiny 1960s planes. And when you start to learn to fly, the one thing that they tell you and the teachers, you have to pick the longest and furthest away visual reference you can in order to maintain a horizon. So I think that's what I'll try to do here. And the reason why you do that is if you pick something nearby, you get disoriented and you might crash the plane, which is not ideal. So what does the future hold and what's in the horizon for us? I think I'd break that down in 2 things. One is at the product level, do you believe that the moats are real and will be there in the long run? I believe reviews are the way that Amazon endorses brand, and brands are sustainable, and they're proven over decades already in this, maybe a decade already in the ecosystem. And it's also Amazon's risk insurance, so that they're not putting a new product that's unproven on a shelf so that an Amazon customer comes and has a bad experience. We think those things are here to stay. And the second to that is if you have to believe that Amazon, the marketplaces, for other aggregators that are in DTC, that the e-commerce is here to stay and Amazon is here to stay and they'll continue to grow. We believe in those 2 things. Now, the second thing that you have to believe in is, do aggregators operate more efficiently than the solopreneurs? And I think that the equation is solopreneur efficiency on one side, and on the other side is aggregator efficiency, plus the economies of scale that we can reach. And perhaps as a single solopreneur, single brand owner, you might not be able to. So economies of scale I've split up in 2. One is the operational that everyone knows is a better freight, you get better product packaging, you can standardize across the board, you get better ad bidding and ad strategies. You also get better reporting and insights at scale. And one of my favorites, what I call the best practice multiplier. If you have 20, 30 brands and you find a good strategy in one of the brands you're constantly testing, you can then replicate that strategy across all the brands and see the benefit. And then the second economy of scale is the capital economy of scale. The bigger you get, then the cheaper working capital you can finance. We've lived the struggle of inventory financing since our early days. And then the second thing is perhaps the one that the sellers are mostly interested in is that we can accelerate the discounted value, the discounted cash flow value of their brands. We can say, hey, take these $1 million today and we'll play it out and operate it over the years. Those things will continue to be true in our opinion, but ultimately the formula or the thing that we have to balance is that we have to be better operators with our economies of scale and more efficient than the solopreneurs that were owning these brands before and who we compete with it and every single day. We think those things are true and will continue to be true. So that's why we're very hopeful in the future. When we look away at the horizon, like in the plane, we see that we're heading in the right direction. Now, why are then some aggregators failing if things are so well or things are going so positively? I would say partly because the space has a lot of people who came in and believed this was a pure arbitrage play. People who had no operational experience said, I'll buy 9 baseball cards and I'll sell them like an MLB team. And the reality is like buying baseball cards is not the same as running a baseball team. Buying Amazon brands is easy. The hard part is to operate them. And a lot of them got carried away with a lot of the markets and things that, sort of incentivize the wrong type of behavior. But also legitimate operators, I think, have struggled too. The headwinds are real. Supply chain has been disrupted. Not just that prices have gone up, but because there's there's unreliability. You have to stock up more. You have to carry higher storage costs. You have to carry more interest on the inventory. That way you don't run out of stock. FBA costs have gone up. And I think most importantly is consumer demand has gone down, especially on the platform following COVID. And most importantly, also with COVID competitors coming in. And then the capital markets have also dried up. Equity has dried up. Some aggregators are still burning cash, and some of them are trapped in very expensive debt. So this is why I think, not hopefully everyone makes it, but I don't think everyone's going to make it. The short term will be very hard. This is going to be very good for those who survive and the good long-term operators. The long term will be very, very bright. We believe in the long term. We've closed deals this month. We've signed new LOIs this month. And we hope to share the space with many, many aggregators in the future.
Thank you, Santiago. Appreciate your thoughts and safe flying. Okay, great. Next up, we have Ruben Bade from eBrands. Are you there, Ruben?
Yeah, hi. Can you hear me?
Over to you, yeah.
Thanks. Yeah, you could, well, so my name is Ruben, here from Finland in the Nordics. If you don't mind, go to the next slide, please. I got involved here like 2020, and I ran a marketing agency before that. And looking ahead sort of 5 years forward, I think as a marketer, one of the things that sort of struck me as part of this industry was that it seemed like more important buying growth than in fact looking at sort of a focused business. And I think sort of looking ahead, if your strategy is to sort of become the next Nike, you don't really get there by buying businesses and sort of that sell car parts and single-use plastic straws. I think you do need to build a more focused business, and I'm sure that as part of this sort of next couple of years, both aggregators as well as sellers will find that they're like everybody aren't for all players, and we're seeing already like signs of this, but I think that's a healthy part that is clearly changing this industry. If you move to the next slide, please. I think the other thing that relates to this is sort of consumers equally are changing behavior. I think more people are becoming aware of what and where they buy stuff from and what type of products they are. In our opinion, sort of looking ahead at Amazon and other marketplaces, I think the algorithm will eventually wake up and sort of change into this changed consumer behavior and ultimately prefer brands that are more responsible. At that point, I'm sure it's sort of too late for many brands to start changing their way of working. I think what you need to do is sort of position yourself to win, given sort of new rules of engagement. In this industry, I think it's sort of less about buying and more about why we do what we do. And I think that's a piece we need to wake up to. I think ourselves, sort of, we've been on a journey to sort of correct, I guess, a wrong where hopefully sustainability isn't the opposite of profit making. And I think that's sort of a journey a lot longer than 5 years, and therefore I think the horizon needs to be bigger. If you look at if you take the next slide, there this sort of demonstrates an interesting case where, for example, our aggregators sort of volumes do make big impact. And for example, just one of our products alone sort of saved 6 tennis courts of plastic, but just changed packaging. And in addition to that, it got cheaper to make. So I guess what I'm trying to say here is as we move forward, I think more businesses need to become more focused. And I think we need to sort of consider how sustainability and profit making become one and the same thing.
Great. Thank you very much, Ruben. Next up, we have Ryan from Elevate. Are you there, Ryan?
Hey guys, yes I am. Hi.
Over to you.
Cool. Hey everybody, you can go to the next slide. Just a little bit about quick background. We missed it. Oh, okay, sorry, I was going to give an update. I didn't realize we removed the previous slide. Quick update about us. We've been selling on Amazon since 2016. Initially started as resellers. So we were reselling branded footwear and apparel. In 2019, it occurred to us that a much more sustainable, robust business model was owning your own brands. And so we acquired our first business in 2019, and then we acquired a few more in 2020, and that's when the big sort of pandemic e-commerce wave hit. We got the biggest surfboard we could find and tried to ride that wave. And so we've now acquired 32 businesses. We've got about 230 people on the team, and it's been quite a journey. So the next slide just talks about. I don't need to spend much time on this. It'll be on I think the materials are going to be shared with everyone. We all know it's a big market. Amazon third-party marketplace. If it were a country, would be the size of the Malaysian economy. It would be like the 34th biggest economy in the world. There's plenty of opportunity for everybody. And it's just a question of navigating that well. And we think the medium long-term view is that Amazon is great during a recession. It will continue to grow. Marketplaces such as Amazon will continue to have a flywheel impact effect that'll do very well. So next slide. So this slide talks a little bit about what Chris Anderson, he wrote a book in 2006 called The Long Tail. And it's an interesting model. And I thought I'll add this into here because a lot of us are going to be sharing the same information. And I thought this one might be a little different and a little interesting. I'll start. And basically the basic premise is that, big, hits, whether across industries, are giving way to micro niche brands, products, movies, videos, etc. So just to see, first of all, who's listening and just to make it interactive, how many music albums do people think, just put a number down, how many music albums do we think sold more than 20 million copies, right, ever? And I'll tell you the answer here. So there were 57 music albums that ever sold more than 20 million copies. How many of that 57 happened after the year 2000? This is where I would love you all to put in. Of the 57 that sold more than 20 million copies, how many of those happened after the year 2000? So the answer is 4. Okay, it's 2 of them are from Adele, one of them's Eminem, and one of them's Norah Jones. Okay, how many albums have ever sold more than 40 million copies? Okay, the answer is 9. And how many? And when was the latest one that sold over 40 million copies? It was 1992. That was Whitney Houston's Bodyguard. So this is so the point I'm making here is a hit album is still a hit album, but there are very, very few albums that ever reach 20, 30, 40 million copies these days. And why is that? And the reason for that is because technology has democratized the way we listen to music. It used to be the case that, the Pareto principle, the vast majority of the benefits went to a very, very few number of hits. And nowadays you have this massive long tail thanks to Netflix and Apple Music, etc. Thanks to Apple Music and Spotify, you have this massive long tail that's getting more market share. The same thing is happening in the movie industry, right? It used to be that everyone used to go to the same movies, and in the 80s and 90s, everyone saw the same movies. And nowadays you have thousands of options you can see on Netflix. The same thing is also happening in the consumer branding space. So, a household brand name is still big business, but those household brand names have continued to lose market share to this massive long tail of micro brands and niche brands, right? And consumer behavior has absolutely changed, and our view is will continue to change. And so that's great news for all of us who are really selling micro niche brands. The other thing is that marketplaces we think will continue to dominate because the customer acquisition cost relative to the lifetime value, that equation is very strong for marketplaces because they have so much selection and keep bringing people back. And so it's relatively much cheaper for Amazon or Target or Walmart to attract the customer than it is for a standalone Shopify store. And you know, these micro brands that we all sell tend to do really well on marketplaces. Also great news for all of us, right? And so like every industry in the world, it matters not just what you do, but how you do it. And like every industry, there will be a handful of winners. Okay, next slide. Okay, but you know, like every industry, there'll be a handful of winners and a handful of folks that struggle. You know, the near term is fraught with a lot of danger and difficulties. What happened to the land grab? You know, you know, in 2020 and 2021, it felt like a race. As an aggregator, I can tell you, it felt like if you missed a deal, shit, someone else is going to take that deal. You better not miss it. You better get this deal. And so guys were paying up, and multiples went from 2.5, 3 times to kind of 3, 4, 5, 6 times plus. And you really felt it, because if you missed a deal, the next one a month later or whenever it was more expensive. And so we really felt that. And you know, aggregators were trying to play this game of not growing, you know, you had all this capital, it was easy to raise capital. And so you want to spend and deploy the capital, because if you don't deploy it and spend it, you're not going to be able to raise another round. And also you're going to get left behind if other guys are growing faster than you. And so the problem is, what then ends up happening is you grow faster than, most of us probably grew faster than expected. And so the old adage that you're more likely to die of indigestion than you are of starvation is absolutely the case. And we've all started to see that, you know, when you're buying a business, in our case, we bought a business every 2 weeks of last year, right? And so that's pretty aggressive growth. Our post-acquisition performance happens to be very good. And so we feel like we've digested it well, but that's also because we've been operating on Amazon for 5 years and we had a really strong foundation. The challenge is, you know, if you're growing too quickly, you can only make 2 mistakes. You can grow too quickly or too slowly. And the bigger I think everyone felt the bigger mistake last year was growing too slowly, but it turns out now that the market has changed, that growing actually too quickly is a much more dangerous thing. And so what we've seen is margin compression has happened across the ecosystem, roughly 700 basis points. Of all the businesses we looked at in the last 6 months, we've seen roughly 600 to 700 basis points of margin compression on average. Most of that is Amazon advertising, as well as logistics and 3PL fees. As guys have said, I don't have to tell you, raising equity today is much, much, much harder than it was a year ago. A year ago, you click your fingers and someone would write you a $20 million, $30 million check. And today, it's a very different situation. And so, you know, folks, as I think Santi mentioned, you know, folks are in a bit of a debt trap. Guys have a lot of debt, and that debt is expensive. And if the performance of the brands don't improve, you know, the way to get out of that is to grow out of that. And so you need to keep buying businesses and getting operating leverage to grow out of that. And the challenge is, if you can't raise equity and you already have a problem with your debt covenants, aggregators can get stuck in this little trap where it's very difficult to navigate out of. And so, you know, operating these businesses is difficult because you've got all these sellers who are very smart and work their asses off, and sellers can work 18 hours a day. And if an ASIN goes down at, 7 p.m. on a Friday night or 9 a.m. on a Saturday morning, you know, you wake up and the first thing a seller does is make sure that their business is doing okay, and you'll fix it if there's a problem. Whereas if you're an aggregator and you're hiring folks, you know, who are earning whatever it is, in the US, maybe 60, 70, 80, $100,000 a year, and those folks are working 9 to 5, and an ASIN goes down on Friday night. Are they checking it on Friday night, or are they going to wait till Monday morning at 9 a.m. to check the ASIN? And so there's all these implications of scaling a business, putting in place process and SOPs that takes time to develop. And when you're growing very quickly and trying to digest so many businesses so quickly, it really becomes very challenging. So next slide. So look, in terms of the business model and how it's likely to play out, I think, and there's a little quote from Warren Buffett there, that a great brand is one that has a moat. And, folks used to talk about Fifth Avenue. Folks used to say last year, I remember there was an article where it said, buying an Amazon brand is like buying Fifth Avenue real estate. If you have a lot of reviews, it's a moat, and it's like buying Fifth Avenue real estate. It's a very safe and secure investment. That is absolutely not the case, right? I mean, these businesses, even if you have a lot of reviews, are not super sustainable businesses in the sense that if you just bought it and did nothing with it, how well would that business do? Right. And, you know, Warren Buffett and Charlie have said great business, they would rather buy a great business with a poor management team than a great management team with a shitty business model, because even the best management team can't fix a bad business model. And the point I'm making is that if you don't continually work on these brands, they eventually lose market share over time. The exception to that is if you have very, very strong brand identity, so you have a real brand, or if you have, let's say, a patent, which is very defensible, right? And so if you have a patent, it's very hard for your competitors to chip away market share. But otherwise, what we've seen is that, you know, the lifetime value of a given ASIN on Amazon deteriorates over time. No one is quite sure, and it depends on what, you know, the shelf life depends on a lot of factors. But you know, these aren't businesses that you can just sit on your hands with. And so I think I'm at time. But anyway, the point is, you know, there's a lot of work that has to be done to continually innovate and optimize these businesses. And consolidation, I think, is something that's going to continue to happen in the ecosystem, because getting that operating leverage is really important. So that's the story.
Excellent. Thank you so much, Ryan, and particularly for the music trivia. Lots of people were submitting guesses via the chat function. Some people got close, but a lot of people were way off. Thank you for that. And thank you for mentioning Warren Buffett's quote. I've followed some of his key musings for many of years, and they have tested the tested time. Okay, next up we will invite Ruben Amar, the co-CEO of eBrands. Are you there, Ruben?
Hey, Emmett, how are you?
Great.
Can everyone hear me well?
Yeah, over to you.
Awesome. All right, we can start with the presentation if you don't mind. Awesome. So sorry, maybe go back. I thought that my first slide would be there, but anyway, I'm Ruben. I'm one of the 3 founders of eBrands. I'm co-CEO. We started the business, you know, at the end of 2020 and have been operating since then. We are based in New York. Majority of our employees are here, and it's been an interesting journey so far, as you can hear from all of my peers here, and as you will hear from all the others. And I'll try to get into that in the next couple of slides. So let's move to the next one, please. So I wanted to present this as like the business cycle, because I think the FBA aggregator market is not different from any new industry that is being created, particularly when it comes in a bull market. So business model of aggregating FBA brands, except for a few examples like one-on-one commerce, really started 4 years ago. And in 2021, you know, money was flowing like never before. And I think Ryan mentioned that thanks to the Fed low interest environment and the post-pandemic health we got from our respective governments, money was very easy to get. And this has really created this mindset of like, hey, let's all be racing for scale. But like with a lot of industries and a lot of new markets, there is a phase that follows very quickly. Oftentimes it happens anywhere between 1 to 5 years, depending on market conditions. And this phase is what we call the downhill, which is often triggered by either macro conditions or by some business models that are being questioned from the early movers. In our case, what happened is that both of them happen at the same time. And that's why it feels like we are going down, and that's where we roughly are in 2022. Now, we are at this bottom point, but as with other innovative markets, we are heading in the right directions. And I call it like the leveling up of the market into what we really believe at Forum, and I think all collectively from the aggregator space, becoming like a more healthy and sustainable long-term conditions for both buyers and sellers. And we really believe that only the operators who have, you know, sustainably scaled and executed with very right precision will navigate through these waves. And I think we should be all very excited that, you know, that where we are going ahead as a market is in the right direction, that I call the, you know, the stabilization of this whole space. If we move to the next slide. So 2021. Market was really hot, and everyone was convinced, as you can see in these, like for those big publishers, with the titles they were giving us last year, that the FBA aggregators was the hottest space to invest in, the best place to inject funds. And as a result of that, it has led to 12 billion invested in less than 2 years. This is remarkable. And the majority of those funds were, generated in 2021. Now, if you move to the next slide, as always, and now in 2022, as always, we say bad news never really comes alone. In 2022, we experienced this downfall that I mentioned, driven by multiple things. I think the number one was that it started with the COVID-driven port closures in China, and the war and the humanitarian disaster in Ukraine have resulted in major supply chain disruptions that have already started putting pressure on everyone's margins, whether aggregators or sellers. Everyone felt it early. This was then followed by inflation, rising costs globally, on and off Amazon. And so all of these factors have triggered the last point, which was the stock market downturn. This has been, very, very challenging for the FBA space, and more broadly for the e-commerce space, given that, as you might all know, our industry is really dependent on reliable shipping, access to affordable products and materials, and steady pricing. All of that have been challenged in 2022. Now, if you move to the next slide, I think, so now we need to all think about it, like, where are we heading? Well, I think that the next 6 months, and particularly 2023, will all be about market rationalization and stabilization. And I wanted to touch base on this slide on what it means for the sellers and what it means for the buyers. So on the seller side, we should really expect sellers to be more selective with the buyers they want to partner with, not only based on how much money they've raised or how much multiples they want to pay, but more importantly, on the reputation and reliability to close the deal and their operations capabilities. The size of multiples and the fundraising is really in the past. I also think we should expect to see some multiples decrease. I think, Emmett mentioned that, where they were from when they were in 2021, as of course a result of increase in interest rates, decrease in supply from buyers, and just a rationalization of the market when there's like uncertainty around future demand on e-commerce. On the buyer side, though, I think buyer will be more selective at the top of the funnel. I think buyers just know a little bit more about their capabilities of operating those brands. All of us, and especially those who started in the 2020, we've learned just much more about how operating these businesses. So we are just going to be more selective. But operations will be key in a way in being successful. And I think it will be dependent on investing in technology, and whether it is technology that you're going to build in-house, which is one way of doing things, or technology that you are going to buy from vendors. In any way, we really believe that technology, like Excel Group also mentioned, is going to be key for better operation and better operators. The second thing I think is going to be extremely important on the buyer side, and where I think aggregators will spend a lot of time thinking about, is how to get our brands to become omnichannel and diversify out a little bit from the Amazon marketplace. Amazon represents 45% of the e-commerce space. There's no reason why our portfolio should not follow that. And so that means we'll need to be smarter about, more growth out of Amazon as well, and more profitable growth on Amazon and off Amazon to build what we think is a successful long-term company. So that's, a quick views on the space. Happy to answer later questions.
Great. Thank you very much, Ruben. We can do questions during the panel session after the 10 talks. So we'll have Sebastian from Stryze speak now. Sebastian, are you there?
I'm here.
Over to you.
I realized that I should have chosen a company name with an A. Yeah, and now I'm the last one. So please excuse if I repeat some of the topics my colleagues here actually mentioned already. A few comments to myself. I am an entrepreneur since 15 years. I've created around 10 companies in the last 15 years, some of them VC backed. I went through the crisis of 2008 quite successfully, and also through the crisis of 2011. And I have some good and some bad news for you guys. I guess what you're interested in is also understanding, can I sell my business in the future and at what prices? And I think the bad news is that probably you missed, in my opinion, the best time to sell your business. And I will explain later on. And the key message from my presentation is that the message is average is not enough anymore. And what I mean with that, I will explain also during the presentation. So please go on to the next slide. Yeah, what happened in the last 12 months? Yeah, so COVID pandemic ended. We saw a supply chain challenges, and we explained that, or others explained that in the presentation already. War in Ukraine, lots of capital going into the market as well. What happened? Inflation was coming and is still increasing due to raw material prices, due to production shortages, and so on. On the other hand, we're currently facing a declining demand, in my opinion, for a majority of consumer goods. So there's a lot of, on the other hand, a lot of supply. I know a lot of e-tailers and retailers which sit on overstock, trying to get rid of it, because, as I said, demand has declined and I think will decline going forward. We see a sharp decline of tech stock valuations. Yeah, the stock market is crumbling down. Stock prices on e-commerce companies, large e-commerce companies. So now you're asking yourself, why does this have an impact on my business and in selling my business? In the end, this gives you an indication what happens in the capital markets. If tech stocks decrease, if the large e-commerce prices go down, then this has an impact on the private markets. All the aggregators are funded from private markets. So if the public markets see a decline in valuation, aggregators see a decline in valuation on the equity side as well as on the debt side, like debt becomes more expensive. And if this happens, the valuations on your business also will go down. So there's a clear decline, and I believe this is going to continue as inflation continues to stay, and that means interest rates go up. Please, the next slide. So what do I believe is going to happen in the next 12 to 18 months? So as I said, I believe inflation is going to stay. And what I probably have to imagine is that we as a Stryze Group, we have a focus on Europe. Yeah, we're based in Berlin. I have been an e-commerce entrepreneur since 2012, in Amazon since 2015. I built an 8-digit Amazon business myself. So all the insights and all the feedback is also based on a lot of data in Europe. We also do sell in the US. We did in total, I think, 32 transactions last year. I think in the US, you already see interest rates going up. In Europe, the ECB it's not moving yet so far, which also has the implication that the dollar becomes stronger and stronger, actually accelerating, on the other hand, the inflation in Europe even more. I believe that asset values, be it stocks, be it real estate, be it private companies, across all asset classes are going down as interest rates are going to go up, as inflation stays or needs to be fought. The demand, I believe, will go down to pre-COVID levels, demand of products, I mean, yeah, or even below, as the recession is coming and people have less money to spend. I don't know how you see that in your markets, but I clearly can see that in Europe and in Germany. Average Joe is spending a lot of money on gas, on food and other things as prices are increasing. And what we also see is that fully landed production cost, what I mean with that is production as well as transport, will stay high or even go up. This has, and this is the next slide, the following implications. top line growth in general will be a challenge. Yeah, I assume that only top sellers, being in the top few positions on Amazon, are likely to continue to grow. So average, being somewhere middle of the page or even below the fold, will mean you will decline in revenues. There will be a margin pressure due to, as we all know, Amazon fees are increasing, advertising fees are increasing because people are bidding more and more because everyone tries to sell their products. COGS are inflated and selling prices stay the same or even go down because everyone tries to sell out the overstock, which was a result of the COVID situation. Funding environment is challenging, will stay challenging. Good companies will get money without a question, as always, but at much lower valuations. So valuations go down, but if you're an average company or even a below average company, you're not get money. M&A, and this is relevant for all you guys who are listening, will stay at a much lower level because buyers are going to be much more selective. Aggregators will specialize, try to create a USP or some specialization. And eventually there will be some consolidation in the aggregator space. But consolidation, I believe, will be more a bigger one buys a smaller one than actually two same size companies go together. So how to prepare? I bet you need to stay as flexible as possible, financially as mentally, being open for totally new approaches to problems. I believe cash is king. Profitability will be more important than top line growth. KPI driven execution excellence is very important. Others also mention automation, meaning putting more and more software into the processes. And what is really important, and this applies to small FBA business, but also large aggregators, create a sustainable USP for your business. This can be extreme excellence in execution. That can mean that you're specialized in a certain market, you're a market leader in something. Whatever it is, create a USP. Be good at D2C, be good at whatever it is, but have something which differentiates yourself toward competition. So I believe crisis is an opportunity as well, as I have seen 2008 and 2011. I believe you need to optimize processes and reduce the cost structure, be it variable as well as fixed cost. Eventually enter into strategic partnerships, whatever they be. I'm not saying about M&A, and think out of the box. I believe the party is over, buckle up, but enjoy the ride.
Thank you, Sebastian. I agree, the party is over, but we will look forward to the next party and we'll buckle up until we get there. So the last 7 speakers have been primarily FBA aggregators. To contrast that, we wanted to not forget about the DTC aggregation industry or space, which is growing. There's an increasing number of DTC focused aggregators. So we've invited 3 aggregators we know well to speak. First up, we have Dianthus. Rob in Boston, are you there?
I am. Thanks for having me.
Over to you.
You want to hop to the next slide? So I'm going to talk a little bit about the new moats in D2C, because I think this is one of the things that has to happen given the changes that everybody's been talking about. We have to buy businesses that have defensible moats, particularly if you can't rely on Amazon for your customer acquisition. So next slide. So I'll tell you a little bit about me. I think I had a slide for that here originally, but I'm a software entrepreneur. And ultimately, we think of Dianthus as a software company that happens to acquire businesses. So we build custom AI machine learning software, particularly with a focus on lowering the cost of direct to consumer customer acquisition. And then we acquire businesses into that. So if you want to go to the next slide. One of the reasons D2C has gotten hard, you remember the long tail slide from a couple of speakers ago. A lot of companies thought they could all be in that, $40 million, 40 million album range on the far end of the slide. It's actually really hard to do with D2C. And given how well Facebook marketing worked and the ease of finding something to drop ship from China, there was an inordinate number of businesses that started that just very easily got to $1, $2, $3 million doing something very simple. It turns out those businesses don't scale well. Your customer acquisition costs tend to break when you try to scale, and you think you can acquire customers for $7, and then when you try to scale, it doesn't go down; it actually goes up quite a bit. So that can be a problem. Other big companies see what you're doing, and competition enters the market. And then really, like, you have too much reliance on Facebook, which with the iOS changes from last summer, that's now broken. Your cold audiences, making them into warm audiences, is much more challenging. So those have been hard to scale. Next slide, please. So what are the moats? What can you do where you can still have a profitable, defensible business despite a bad macroeconomic picture? We think there are four. They're the four listed here. And I'll talk briefly about some examples that we've bought, some of them we haven't bought yet, and then why I think these are important. Next slide. So I think the best moat is personalization. It's something that's hard to do through an Amazon-style workflow where it's one-click buy. It's something that's hard to do in general, but it gives you deep customer engagement and unique products for people. What you see here on the right is pictures from one of the businesses that we bought, where people can upload a picture of their pet and you can crop out the head and print it on a pair of pajamas, so your dog is on the pajamas. Very, very popular. For us being a software company, one of the first things we did when we bought this business was we built a machine learning model that removes the background of the picture of your pet to isolate the head. And so instead of having humans do that for $3 per pair of pajamas, that's now effectively free and runs in 1 minute of compute. So, which by the way, saved $750,000 directly to the bottom line, because they'll sell 250,000 pairs of pajamas this year. So, so next slide. We also think that what we would call non-trivial manufacturing is a good moat. People have drop shipped so many things or had things that were just really, really super easy to make. And those are hard to defend over time as other people figure out how to make them. Now, obviously, we're all, you're doing these small companies, and, we are not like chemical companies by training, so we can't manufacture anything that's like super complicated. But even something that just has a little bit of work to it turns out to be pretty defensible in the D2C space. So again, this is a product we have, Cuddle Clones, where you can upload a picture of your dog, and we make and airbrush a lookalike of your dog. It's very, very popular. And it, we have a wholly owned manufacturing subsidiary in China that does these things, that employs about 40 people. So having these workflows, we have these in some of the other businesses we built, but we look for things that have some simple but not too simple type of manufacturing, because we think that know-how, that workflow is a good moat. So next slide. A complex buyer's journey. So it turns out there are just these random categories of products that, given they have lots of product features, there's lots of buyers, they have different needs, it's a very fragmented market, and it's really hard to make a product that meets everybody's needs. When you can find these products, they're really, really good for D2C. So here's an example with inflatable kayaks. Do you want 1 seat? Do you want 6 seats? Should it fit in a backpack? Whatever. Like, this brand that we bought, Air Kayaks, sells more than Amazon and REI, because the buyer's journey to buy an inflatable kayak is very complicated. So we look at this, we think this is another emerging moat and something you can look at acquiring. And then last slide. And the final moat, and I think a lot of people have seen this one, is what I would call content and community. So when your prospects come to you as the expert, when your prospects are part of a community, either when they're learning about your product or once they've bought your product and they're engaged, you see this a lot in some fitness places with like running gear and yoga gear and different types of things like that, wearables and stuff like that. It dramatically lowers your customer acquisition costs and increase your lifetime value of the customer. So you don't have to spend so much money on advertising. This is a great new moat, and not many e-commerce companies have done much content or community building. So it's a good skill and muscle to develop as well. But obviously, if you can acquire some of that, even better. And I think that's all for my slides.
Great. Thank you, Rob. And it's great to see an aggregator really focus in on tech, data, AI, ML, etc. I think not enough aggregators are looking at that properly. Great. So we're going to travel now from Boston back across the pond to the UK, where I'll invite Casper from eComplete to the floor. Are you there, Casper?
I am. Can you hear me?
Great. Over to you.
Fantastic. Hi, I'm Casper Waters. I'm one of the founders of eComplete. We are an aggregator of larger scale D2C businesses in e-commerce. If you can move on to the next slide. So I think when the aggregator space really got started, it was founded on a principle fundamentally of multiple arbitrage funded by cheap debt. I think as that becomes significantly more difficult in a downturn, aggregators are going to be judged on basically the same criteria that consumer businesses have been judged on when seeking investment historically. And so I've got 3 points here that really relate to D2C businesses in general, and then one that hopefully sums it up for aggregators. So if we can go on to the next slide. The first thing is, we spoke a lot about, funding and raising money. That there's no secret that, 5-10 years ago, private equity was only really investing in pretty large scale e-commerce businesses. They made up generally a small percentage of private equity portfolios and a very small percentage of listed businesses, particularly in the UK. And I think that is because there isn't a leverageable asset base. There is huge advantages to scale in terms of margins, differentiation of marketing channels. You have more money to spend on new product development. The life cycle of a product might be short, but a brand can be very long. And investors really want to see that sustainability and quality of earnings, which really requires a degree of scale. And that's also sort of mirrored by the increase in valuation for later stage businesses over time. And part of that is a flight to quality, but that's also applied to the funds themselves. So more money every year gets raised, but typically by fewer and fewer funds. So that is going to lead people into larger rounds for higher quality businesses. If we move on to the next slide. And what really drives your ability to scale is a high quality product, right? And I think the easiest way to reference that is by having a high gross profit margin, because that means you either have a very valuable brand that people are willing to engage in and you can protect prices, or a very unique product. I mean, we spoke a little bit about death by 1,000 paper cuts, and the difficulty of that applies to Amazon businesses as well. If you are competing next to a business on Amazon, then you are a direct price competitor. It's never been easier to access B2B e-commerce. It's never been easier to access a huge range of dropship products from China. And you're always going to be fighting a price battle. Equally, higher quality businesses are engaging with their buyers. Social commerce sales are set to triple. China is one of the most advanced e-commerce markets in the world. It's already a huge marketing channel and a huge sales channel there. So if you can demonstrate to investors, if you can demonstrate to buyers that your business has genuine brand value, high gross profit, and a very engaged consumer base, I think that the next year, 2 years is still going to be a very profitable and very exciting time to be in e-commerce. Whereas if you are still doing the low price, pack them high and sell them cheap model, it's going to be very, very difficult. And the last point there on the slide really demonstrates that. For businesses with a gross profit margin higher than 50%, you have a revenue multiple of still over 1 times, and for businesses below 50%, it's going to get harder and harder to sell the business fundamentally. So if we move on to the next slide, what do you do when you have a successful business, when you have generated that audience engagement, that high gross profit? You want to scale it as quickly as possible to get the benefits mentioned above. And the real advantage of e-commerce is that you can open a territory faster than a traditional retailer can open a store. And when we talk to founders about their international aspirations, it's virtually always the US first. They go, it's the best market, it's Anglophone, so it should be relatively easy to do. Through our analysis, the US is one of the most competitive e-commerce markets in the world. It's about 3.5 times more competitive than the UK, and that's a measure based on the percentage of traffic captured by the 10 largest brands. Whereas actually, because you can open territories very easily, you can use 3PL in different territories, you can use lots of services to internationalize a business very quickly. You should be targeting niche territories in Europe. You should be targeting the Far East. 52% of all retail e-commerce sales globally are happening in China, and it's the only continent where the middle class is actively growing in purchasing power. The key, though, really is doing it in a localized manner. It's not good enough just to spin up a website in a foreign territory and still try to fulfill from the UK with limited internationalization on the actual website, because while 2/3 of consumers have made a cross-border purchase, 40% of them won't buy from a website in a language other than their own. So you really have to be able to speak to a consumer in their language, both literally and metaphorically. So if we move on to the last slide to talk about how this really affects aggregators, aggregators have to prove to investors that they're adding value to these businesses. And the data analytics is out there for you to show that with the scale that you're providing, with the talent that you're providing within your aggregator, you are driving an improvement in cost base, you're driving an improvement in repeat rate and costs more generally. I think you have to have a coherent strategy for why you're buying these businesses. Ideally, you're aggregating them together so that eventually you can get to a point where you have a very large brand that is relevant to the most likely buyers. And I think in e-commerce, the biggest trend is the very, very large players, the LVMHs, the L'Oreals of the world, are desperately trying to own the customer and move away from a distributor model. And therefore, the aggregators have an awesome opportunity now to build very, very coherent, large D2C businesses that you can then actually sell and recycle the capital. And the real excitement of that is the best time to be aggregating and buying businesses is when they're small and you are adding the most value. When they get to scale themselves, arguably they don't need you anymore, and you should be using that capital to back yourself to do it again. And that's all from me.
Great. Thank you, Casper. Okay, so we're going to move back across the pond to New York now and welcome Fan B from the Hedgehog company. One of my favorite aggregators, very niche and focused, differentiated, and one that our Angel Syndicate has invested in. So delighted to welcome Fan to the floor.
Thanks for having me and the team. Great to be here. So as Emmett said, we have a slightly different purview on the e-commerce aggregation space. And if we can go to the next slide, I think this 2x2 shares kind of our view, which is most of the conversation today is about FBA, and part of the original thesis that you could buy 101 and aggregate profitable businesses together. And for us, we're coming at it from a slightly different vantage point. I was a D2C founder with a not yet profitable D2C brand. And if you can go to the next slide. So why is that, and why are there thousands of D2C businesses like this? So the VC community entered the space a handful of years ago. A lot of well-capitalized D2C businesses with equity. A couple of years later, e-commerce fintech lenders entered the space. Again, hyper-capitalized D2C businesses. And what this meant was there were a lot of D2C businesses that had raised a lot of money in the form of equity or credit, and had built meaningful brands that resonated with their customers, but they didn't need to be and were not yet profitable. You can go to the next slide. And so with this generation of D2C founders in the early kind of 2010s, a lot of these folks, myself included, had been at it for 6, 8, 10 years. At a certain point, the music starts to stop. The equity markets for D2C brands slowed down a few years ago, especially with this current macro environment. Lending hasn't gotten much tighter. So you have thousands upon tens of thousands of D2C brands that are out there that have built brand equity, have built elements, kernels of a great brand that has affinity with their customer, that commands good gross margin, that has a customer trail, but are not yet profitable. And so that's kind of where Hedgehog has come in, and we believe that there's an opportunity to aggregate these, and with shared services and customer-less overlap, build something that can be profitable. So we can get to the next slide. Now, we're obviously experiencing the same market conditions. There are a handful of public D2C aggregators, including ones that have gone public recently, AKA brands, solo brands, and they've been bundled in with growth tech, which is down 75%. And again, everyone has kind of talked about that today. Hedgehog, we're in an interesting position. because of this challenging environment, our deal velocity has actually increased. We're seeing more deals than ever because of this kind of the tide going out for capital markets. At the same time, we're experiencing that same pain, limited capital, and like everyone else mentioned, more of a focus on profitability. But beyond profitability, it's a focus on free cash flow, because the thing that is with Hedgehog that is unique to most, that is common with most aggregators, is that there is typically leverage involved in acquisitions. There's leverage involved in that stack. And at the same time, because we're all product and inventory-based businesses, we've got cash going out to fund sales, typically 60, 120, 180 days even out. And so really managing cash, both in terms of the balance sheet as well as operating a product-based business, is like very top of mind for ourselves, for other D2C businesses, for the aggregators we know. But to what eComplete and Dianthus and other, especially D2C where we focus, is there are large holding companies for a reason. This is and consumer holding companies that have existed for decades, 50 plus years for a reason. And there are synergies around supply chain, around distribution, and for us, the big advantage and the big premise for D2C, having both a dozen years ago, is that you have the first party data. And so the difference between the LVMH or the Procter & Gamble is that there, where your customers are, you can speak to them directly, and that data set is much richer. And so in terms of the future of D2C aggregation, I absolutely believe that there will be large winners that first party that own the first party data relationship with their customers, that will be able to buy and continue to own brands that will start with that advantage native to them. We're going to work through the shakeout together, but on the other side of that, I think all of the original promise of both D2C and aggregation are still absolutely there, and we're still incredibly excited about the future.
Great, thank you, Fan. So that brings to an end the presentation section of today's webinar. Thank you to all 10 speakers for sharing your views. And now we will move to section 4, where we have over 35 minutes for discussion and answering your Q&A. Given the looming recession, valuation was clearly a theme entwined in a lot of the presentations over the last hour. So we wanted to address that head on before we go to other topics. So if anyone has questions specific to valuation, please submit those via the Q&A button now. If I could ask all the panelists, please, to turn on their camera and be ready to contribute again. It's the largest panel I've ever done on a webinar. So to help out, please, if you can raise your hand, if you can press that button, raise hand, if you would like to answer a specific question. Otherwise, I will come to you direct. So to prepare for today, given valuation is such a key topic, we asked some of our buyer clients to complete a survey over the last few days regarding valuation. So I'll just quickly take you through that, and then we can ask the panelists for comments. So first of all, by what percentages has valuations declined in your deals on average? That's Q2 versus Q1. And approximately 76% said valuations declined by over 30%. Only 5% of aggregators, of the 35 aggregators, said there was no decline. So clearly there's been a reset. There's been a reset on listed companies, unlisted companies, and e-commerce brands can't escape that, nor can aggregators. We asked, by what percentage has your volume of deals declined Q1 versus Q2? Approximately 30% reported a small decline of 10%, but 30% said deals were down over 50%. Maybe that's something we can come back to. Including completed deals then, how many do you forecast to complete this year? and the small minority said 21 to 30. That's very different to our survey of aggregators last October. And 43% said just one to five deals. So starvation does look to be better than ingestion, as Ryan was alluding to. On the chart, then, we wanted to surmise what multiples people are seeing today. It's important to note that these multiples include deferred compensation, which can be a stability payment. It can be, an earnout, whether that's based on revenue or STE. But clearly, the multiples have declined since the last time we've surveyed the aggregation market. 82% are saying it's between 2 to 4x STE. I think for the DTC aggregators, the multiples will be higher. They've traditionally been higher. It's slightly different businesses, ones that own their customers. So I think it'd be skewed higher for those types of aggregators. And then finally, probably no surprise that the upfront payment has decreased as a percentage of overall compensation, 65% saying so, as the buyers are looking to sort of de-risk the acquisitions. So to kick off, I'd like to ask some of our panelists to give their feedback or thoughts on some of those stats and make it relevant to what they're seeing. Who'd like to kick off? If someone can please raise the hand. Casper, over to you.
I think the one thing I would say is that while the news does seem pretty bleak in terms of valuation, we're still seeing the best businesses raise at very high valuations relating to e-commerce historically. So I think it's more of a bifurcation in what the market is doing, because there is still a huge amount of capital out there that's looking for a home, and there are still a number of larger D2C businesses with a very attractive margin stack that are attracting similar multiples to what they would have done midway through last year. What I'm seeing more is that the businesses on the lower end just aren't transacting at all. And so if anything, our net multiple is broadly remaining similar, but we are focusing much more on quality than ever before.
Great. Thank you, Casper. Yeah, that's a good point. There are outliers on the downside and the upside, particularly if revenue growth is still strong and net margins are still strong, good trajectory. Ruben, I'll bring you in here, please.
Sure, thanks. Yeah, although what Casper said, I think something that's very important for all of us, most likely, is the simplicity of the business from an operations perspective, from financial profile perspective. So I think while back in 2021, I think we were very looking at, top line growth. We were looking at margins, of course, because we had to buy businesses that were profitable. I would say, like, this time of the year, the simplest businesses that have, the highest revenues for manufacturers, highest revenues per SKU, high volume of reviews and ratings, sustainable, I would say stable growth versus peak growth. All of those, like, high quality unit economics that we call, like, the product by product unit economics, really helped the brands get better multiples. All of the other brands that have not been able to show these metrics, almost check, those are the ones that, like Casper said, sometimes don't even manage to trade. But still, the ones that are of very high quality from an operations perspective still get pretty significant, I would say, like, multiples compared to historical levels. So the operations piece is also extremely important.
Agreed. Thank you, Ruben. Robin?
Yeah, no, I just wanted to say that I think from the way we look at these brands, it's like there's sort of lighthouse brands, and then there's sort of what you could call more of cash cow brands. And I think the lighthouse brands that where we clearly see a great opportunity to grow and the sort of added value exists there. I mean, I think even the sort of plus 5x sort of multiples are justified as long as you just know that you can help grow those brands. But otherwise, clearly seeing that there is a decline. for sort of more general businesses.
Thank you, Robin. Sebastian.
Sorry. Yeah, I think your numbers, first of all, thank you very much for sharing those. I think that's quite a nice overview, basically showing the numbers you have as an aggregator, what you see in the market. But this is great to see it. That's actually that everyone sees very similar numbers. I think the reason or the reasons are two reasons. One is that the intersection of the demand and the supply of companies move to a much lower level. Yeah. On the one hand, you have a much higher supply of sellers because first of all, the sellers realize that the business is getting more difficult. It needs to be more sophisticated. Size plays an important role. So people want to get out of the business before it totally crumbles. Margins go down and so on. So that's one thing. And the demand, we also see, I mean, here your question, how many deals people want to do, the demand is declining. Yeah? So we clearly have this as one point. Yeah. And on the other hand, I think the result of the declining valuation is also created by much more uncertainty in the specific business itself. Yeah, when you looked at companies in 2021, especially in the beginning, you were thinking, hey, this business is great, it's growing, it's rapidly growing, so the risks seem to be much less. Mm-hmm. Nowadays, you see a lot of stable businesses slowly growing or declining. So in order to take this in consideration, I think lots of aggregators put some discount on the multiple. Yeah, and also margins go down. Yeah, a lower margin makes it much more complicated for an aggregator to invest a high number of dollars. So I guess that's the result of those two things. It's not just demand and supply, it's also the risk, the inherent risk in the business itself.
Yeah, thank you, Sebastian. So moving on to a specific question that's come in. What are the average upfront multiples you guys are offering to sellers, not including, stock earnout stability payments? Does someone want to put up their hand for that question? Upfront amounts. Nick, is your hand is still raised? Over to you.
Yeah, it was like for the previous question, just like wanted to add that, it's like the quality, what we are seeing, that the quality of the pipeline of the targets are a little bit like different. So it's like decreasing because like the really great targets, thinking whether they can like sustain the recession, inflation for the next like 12 months and then like be bought for the multipliers that were here like half a year ago. And especially it's also like we are dealing with people, and a lot of them like have the friends or have contacts that they've bought, and it's sometimes just like really hard for them to negotiate and agree on like 3x or 3.5x when they know a lot of in their network were acquired for 4.5x or for 5x. So what we see, definitely multipliers are decreasing, but the quality of the pipeline also decreasing. So yeah, just want to add this.
Yeah, thank you, Nick. And anyone want to answer the specific question? What upfront multiples are you offering to sellers? Rob?
Yeah, so we've been buying things still sort of 3 to 5 things SDE, and we've been structuring our payments. In the boom, we were structuring them 50% up front, 25% after year 1, 25% after year 2. Our model is to try to grow the marginal cash flow under our ownership enough to cover those back payments just from the additional cash flow generated. We've been able to see, I would say, in the last couple of months, people take as little as sort of 35% in upfront payment and more backloaded payments. Mm-hmm. So, small sample set. It's just been a couple of discussions that we've had on LOIs, but they've definitely come down from sort of 50% to 35% pretty consistently.
I'll ask Nick to answer that in a second. The next question for the panelists will be: what is the expected multiple for DTC and maybe for FBA? What are the ranges people are seeing? If it's different to the slide on the screen. Nick, over to you.
Yeah, I'm like we're not buying like D2C, we are focusing on FBA. So like in terms of multiples, we are focusing on the business like with 5 to 10 million in revenue. So it's like 1 to 2 million in SD or asset level EBITDA. And for like, let's say sustainable margins like from 8%, what we currently see and what we are offering is like more like 3.5, like from 3.2, 3.1 to like 3.7x. So this like where we see if there is like still like okay growth, like 10%, 20%, and if there's still like okay margins. So this like where we are seeing the market and what we are offering.
Okay, let's move to volume now. We touch on volume on this slide. What are people seeing in terms of volumes? Clearly, I assume it's decreased, but if anyone has some stats on that, it'd be helpful. Rob, you've raised your hand.
Oh, sorry. I didn't realize I had to lower it after I answered the last question, but I will go ahead and answer this one too. So we're still on track for what we intended this year, but for us, we have to acquire enough to sort of cover our tech overhead. And so we've got, almost enough capital to do that. So that's part of the plan anyway. So we're not slowing down. We've actually had discussions with our investors about beefing up. They feel like since multiples are down, even though our valuation will be down when you run the math, acquiring these companies, if you think, depending on your time frame of when you think the economy is going to rebound, if you think it's no more than 12 or 18 months out, probably makes sense to pick stuff up more cheaply and lean in if you can get access to the capital. But that may just be how our investors feel about it. I don't know how the general industry feels about it.
Thank you, Rob. Santiago, on the volume question.
So we've seen deal flow actually remain equal or slightly increase. I mean, part of that could be driven because we were less known before. Now that there's less people acquiring, it might be a little bit more known. But I think actually our total net volume of transactions has gone up, whether you measure it by LOIs or closed deals. Before we would see the same amount of deals, but then there were 7 people or 8 people bidding on the same deal, sometimes going to crazy multiples. Whereas now we can really get what we want and what we pick. So we expect this year to be either equally or more acquisitive than last year, and pipeline has remained the same. Now, some of the pipeline quality has gone down because people are suffering from post-COVID. So we might pick less from that bunch, but the ones that we pick, then there's a way higher success rate of us getting that deal through the finish line. And we were very lucky to commit a lot of capital before this all happened. It wasn't by plan or design. It was pure luck of timing. So we expect to do more deals this year.
That's very refreshing to hear. I'll ask Fan to answer in a moment. The next question I'll ask the panelists is, which categories would you prefer going into a bear market? I think that's a great question. Back to you, Fan, on the volume question.
Yeah, so for us, because we're a not yet profitable kind of turnaround buyer, our pipeline has really started to accelerate, and I think it's only going to be that way for the next 6 months or so. There is definitely a lot of pain in the marketplace, and at the same time, as much as our pipeline is expanding, we are being much more careful on a go-forward basis. I think the bar is much higher for what I mentioned earlier, the amount of brand equity we need to see in a business. We're being much more conservative with our purchase prices, and but we think that we will make up for it just by how much the pipeline has increased.
Apologies. Thank you, Fan. Anyone else want to touch on the volume question before we move on? Okay, so great question. Which categories do you prefer as we enter a bear market? Casper.
I'd say a couple of different things. One would be smaller cube sizes, just because it's much easier to ship smaller things globally, and significantly easier to pass on any cost increases per unit with small cube sizes. Beyond that, it's categories which have traditionally done well in recessions. So mother and baby and pets are two very attractive categories, and then luxury and higher unit cost, unit price goods, because typically that segment of the market is generally more immune to significant slowdowns.
Thank you, Casper. Sebastian?
I think we would look less at businesses which had especially a push during COVID times, not just because of higher revenues in the past and the margins, but more on the fact that you have significant higher competition because you have so many new entrants in the market, as well as significant overstock. That's what we clearly see, like especially in those categories of sports and some others, where people were buying during COVID time so much stuff. There have been so many new entrants in the market, as well as people just pouring products into their warehouses. And now they're trying to get rid of this. I think that's, to everything else what Casper said, I think that's what we would look at less at.
Thanks. Thank you, Sebastian. Ruben?
And I mean, we're very focused on sort of wellness and health related products. I believe there's an opportunity and to sort of support some of the earlier comments, like premium priced products, I think are interesting in this space over time.
Okay, thank you all. Let's move to inflation. It was a good question earlier on. How are you dealing with inflation? What pass-through measures are you taking? Clearly, it's a concern for aggregators and brands. Nick?
Yeah, so we are right now like testing, like trying to put like all this in the price, like to put it on customer. As it like wrote in the chat, we succeeded with like 20-30% of our portfolio. Still like struggling with others. So we don't see like, because like in some categories we just see like Chinese sellers, they just like even like lowering prices. So it's not that easy in some categories to push that on the client. And definitely, I'm like, if we're comparing our P&L to the previous year for all our brands, the biggest expenses that increases like the tacos. So it's like marketing, it's not even supply chain. So we are working with like optimizing tacos, with optimizing promo budgets. So it also like to give us more margins.
Thank you, Nick. Ruben?
Yeah, so I think inflation has two impacts on aggregators. One, on the debt side, which is, I think it's important in the context of the conversation here. You know, in order to face inflation, Fed increase interest rate, and therefore debt becomes more expensive. Therefore, we need to be much more mindful about the multiples we're paying. So one of the consequences of, you know, inflation is reflected in how much multiple we are willing to pay for certain assets. So that's part of like what we talked about already. When it comes to the second piece of how inflation is impacting aggregators, the natural and very easy way is to say, okay, let's put everything on the ASP on our listings. But I think it's important to look at it holistically with a lot of data. The good thing is that Amazon and many other providers around Amazon provide a bunch of data that allows us to have a serious like thought about elasticity and what impact does it have on a volume. Because while on certain occasion the ASP increase could have like I would say a positive impact and a creative impact on bottom line, it could also go on the other way. And so as we think about ASP, of course, inflation is reflected into ASP, but for us, it's more about how can we thoughtfully bring the inflation into ASPs on certain SKUs, looking at a ton of data that exists on Amazon for us to know what is the impact on demand based on each incremental dollar that we'll put on a you know SKU level. So
thank you, Robin. Back to you, Rob.
So we've done two things to try to deal with inflation. One is we've changed up our paid marketing mix. to try to focus on, coming into the year, some of the things that we thought would have certain margins or certain shipping costs. Obviously, those have changed around some, and so we've been pretty dynamic in trying to change what we promote to try to keep sort of the same margin profile at the same bottom line, even if we generate a little less revenue. And the second thing is we tried to prioritize some projects that we had going on around dynamic pricing. So really trying to, instead of discounting across the board, to try to sell more and of stuff that we wanted to get rid of, or instead of raising prices on stuff, we've tried to we built some machine learning models that make educated guesses about what customers will pay, and we prioritize that over some other projects that we had, so that we could hopefully optimize that pricing via different customer segments and clusters sort of automatically on the website. So that's where we focused our time.
Thank you, Rob. Sebastian.
I mean, look, if I look at inflation and if I try to, like, how does inflation impact us? It's on the cost side, yeah, and especially on the production side. Raw material prices go up, transport and so on. So the question is, can I pass that through to the consumer? And clearly you cannot. It really depends on the market. Yeah, in your very specific on each SKU. Yeah, where our business is not managing brands. Our business is managing ASINs. I think that's the entire secret of the business. Can you manage a portfolio of 5,000 ASINs as well as you did it with 5 ASINs or 50 ASINs? Yeah, I think that's the thing. So I believe you cannot increase the prices above the market prices. Yeah, always under the assumption you cannot change your review profile. That means you need to compensate that. If the market doesn't move up, you need to compensate it through cost savings. What other costs do you have? Try to get transport costs down by optimizing there, maybe changing the supplier. But in the end, the variable cost probably will over time increase, leaving less margin. And I think that on the entire business means size will matter. Yeah, so you will have less margin to cover overall costs. Size will matter, as well as you have to invest into outsourcing to low-cost countries or invest into technology, reducing your overhead cost.
Thank you, Sebastian. Back to you, Ruben.
Yeah, I mean, I think part of it's probably summarizing that this inflation has had clearly a fast forwarding role towards sort of supply chain optimization. I mean, we can see that, for example, packaging has become an increased focus. We're trying to make the same product but smaller packaging, and therefore you save cost. And as you can't push it all towards the end consumer, I mean, it's sort of clearly fast forward the projects we had around supply chain in general.
We have just over 10 minutes left. I'd like to ask all of you, what is your top prediction for the space? If you're to boil it down to one prediction that we could hold you accountable for, what would that be? Who'd like to go first? Richard, you started the space. You might as well start this answers to this question. Go for it.
Sure. I think there's a little too much talk about how long this is going to last. And my prediction is it's going to last longer than people think it's going to last. And I think the thing that's key is, even once you're out of a recession, I think we're going to have slow to no growth in developed markets. And the interest rate situation, I think, is really the bigger thing to watch in this versus the actual economic conditions. And interest rates, in my opinion, and a lot of economists' opinions, are just going to go up and keep going up for probably the next three to 4 years. And they're probably going to stay there until they can rein in this inflation. And look, we had 10 years of 12 years of ridiculously low interest rates, totally unrealistic, unseen in history. And then with the COVID recession, the overreaction by the U.S. Federal Reserve and subsequently all the other central banks taking interest rates and just flooding to zero and flooding not only interest rates but flooding the markets with liquidity as well, just inflated asset classes of all types. And so I think, as sellers there, one of the things I'd be cognizant of is you see the great aggregator bonanza of 2020 and 2021 when $12 billion was pumped in and there's all this competition for deals and multiples keep going up. I mean, those multiples are going back down, and we've kind of covered that. But I think they're going to stay down as well. And I think all asset classes are kind of going to go sideways. And you could probably talk about real estate or the stock market or whatever. But one of the things I did want to say earlier, to the sellers that are in the audience is, look, you can't time the market. You have to find liquidity when you have the right liquidity window for your business or your family personally or whatever. And so, one of the things I would tell the sellers in the audience is, like, if you think, oh, well, multiples are down, I'm just going to wait. I would highly advise you to rethink that and think more about what is the best liquidity window for the exit of your business, if it's a pure business issue. And then the other thing I'd say is, everybody, look, you all have personal lives and personal needs and stuff like that. Sometimes there's just a time that's right for you to sell from a personal standpoint as well. So that's my prediction and a little bit of advice.
Thank you, RJ. Rob, over to you, please.
So I'll take a position that probably won't be very popular. I think Amazon is more assaultable than people think. I'm an active angel investor. I've seen people with very early stage ideas for how to take on Amazon, and obviously not that it's going to go somewhere, not that's going to go away soon. But I think as you look at Amazon's growth over the next 5 years, it's going to be shockingly low compared to what people would predict today that it's going to be. So I think you're going to start to see the disaggregation of Amazon and a lot of the way they serve customers. So figured I'd throw something controversial out there for you guys to talk about.
Thank you, Rob. Always appreciate controversy, gets the debate going. Ruben, over to you.
Yeah, very quickly. My biggest prediction is that there will be much more discipline from aggregators, the ones that will survive over this stabilization period, which I think is good for everyone. And the number two is that people and all the remaining aggregators that will get into this stabilization phase will think more and more and will execute more and more on the omnichannel piece, just to kind of mitigate those risks that are related to one marketplace. And I think it's going to be increasingly important for both the sustainability of our brands, but also from an equity perspective, equity fundraising perspective. Investor will be looking much more for that piece than before.
Thank you, Ruben. Rob is taking bets on his comment there. If anyone wants to formally subscribe to his bet on via the chat. Okay, next up, Nick, please.
Yeah, so we do believe that, let's say in 2-3 years from now, there will be less or around 10 aggregators that will be there in the space. So we don't believe that 80% of the aggregators will do that in 3 years. And also, we do believe that we'll see much more competition, much more market share that will be belong to just top sellers. So they are not aggregators, but they are right now top 10, top 50. So they also will be in this game. They know the space, and they will be much more active, and will be in more competition with them.
Great, thank you, Nick. Casper.
I think this webinar is a good example of the amount of quality in the space, and it probably represents the biggest series of investments into e-commerce and brands more generally, over any period of time. And I think that the logical end case of that is that you're going to start seeing household brands built within the aggregators. And I think that when those businesses become arguably better known than the businesses that built them, they will start to be sold at much higher multiples than people are paying for Amazon businesses or small D2C businesses today. And I think that will reignite the space over a period of time as people start really believing the multiple arbitrage story. Because if you're doing something over and over again at the kind of scale that some of these businesses are doing it, you are going to outperform the market, and I think people will see the value of that over time.
Thank you, Casper. Who'd like to go next?
Well, I guess mine relates partially to that. So like I believe that the whole sort of omni-channel topic will definitely become more important here. And like ultimately that will lead to us probably not sitting here being D2C or FBA aggregators. I think that will become sort of businesses that clearly understand what like a sort of native digital sort of brand looks like today. And maybe we all become brand houses of some sort.
I agree with that. I definitely think there'll be a convergence. Sebastian?
Yeah, I guess what we will see is that the focus of aggregators in general will move from M&A more to organic growth. Yeah, because that's necessary in order to, at some point, we all have to pay back the debt. Yeah, at some point, I don't know how it's about the others, but at least in our case, it's like that. Yeah. So that means you need organic growth. Then the question will be, is it better to manage 100 brands or is it 20 lighthouse brands? So eventually we'll focus on a few ones in order to grow them, to really build out brands out of this. And therefore I believe M&A will become less and less important. And there will be M&A probably on the long term. But look, I mean, I have been in FBA many, many years before. There was nobody interested in buying an FBA business. That's what I said in my presentation. This was insane in 2020 and 2021. And the reality is that if you didn't sell your business in the last 2 years, you probably missed a huge opportunity. It doesn't mean that you cannot sell your business in the future, but at way different conditions. To grow it will be much, much more difficult. As explained, margins go down, growth of Amazon platform is going to be slower, and so on and so on. So it will be less fun. The last 2 years with COVID, you had a tremendous growth. Even if you were average, you were growing. Even if you weren't even good, you were growing. And even you could sell your business. And this has changed. Now it's a hard market. It will be professionalized. It will be professionalized in the aggregator space. There will be a few left. They will consider themselves not anymore as aggregators, but as e-commerce companies, multi-channel e-commerce companies, power brand houses, whatever. So FBA aggregation was just a growth channel. There was pouring a lot of money into the market. This is going to be over. Yeah, the ones which have money will spend it wisely. Because there's probably less money coming back. Eventually, there will be an IPO of someone. I don't know if it's Thrasio, or if it's Perch or Elevate or someone. We'll see. But this is going to be in the future, 3, 4, 5 years from now. And therefore, right now, focus on operations, getting a good business, and really prove that you can grow your brands. Sorry.
Yeah, thank you, Sebastian. We've got like a minute left for Ryan and I think Santiago. Ryan, 30 seconds to you, please.
Yeah, 2 things. I think the strategies of the different aggregators are starting to diverge in terms of category focus and channel focus. Those things are starting to continue to happen. So that's one trend that's happening. And then I think consolidation is something that will continue to happen. I think some of the consolidation will be because of distressed aggregators. No one on this call, but maybe others outside. And then, you know, there will be some opportunistic consolidation as well for operating leverage and strategic purposes as well. So I think that's something that is likely to happen.
Great. Thank you, Ryan. And to finish, Santiago.
I hate making predictions because I'm always wrong. So I'd say that there's probably going to be less aggregators tomorrow than today. And I don't see that as a good thing. I think it's just a natural thing. And that's all I can probably say. It is, but what I will say is there's going to be at least a few, right? The aggregators are here to stay. The model makes sense. It probably will be a lot more boring than it was a year ago, but it'll be around.
Brilliant. folks, thank you so much for taking the time out today to participate in this webinar. Really appreciate all your time, your comments, your content. As a reminder to all the attendees, both the content and the recording will be made available to you all by email and via our website. So hope you all found that helpful. Thank you again for the poll at the top of the webinar to determine what topics we should bring to you in the future, and we'll get working on that in the coming days. Have a great day, everybody. Thanks again.
Thank you. Bye-bye.